big picture, we've talked about how crypto and especially Bitcoin, have kind of matured over time and probably do have some, allocation within a well-diversified portfolio. And I guess, having it be a little bit easier to implement probably isn't a bad idea. I think that being said, this has been so well telegraphed and the price is, close to almost doubled over the past 6, to 8 months that, probably be a little bit cautious with respect to kind of timing and adding that allocation over time. But I think more broadly, I think it just speaks to how much momentum, positive sentiment there is in these markets right now.
Yeah, it is kind of interesting. I mean, are you fielding a lot of questions though, Samir, about people like, hey, Samir, how do you feel about this, new round of ETFs, if you will, spot Bitcoin ETFs? Like, should we have some exposure to them? Because as our Eric Balchunas said, like, what if these guys are right, that this becomes something significant in our world in terms of Bitcoin more broadly?
Yeah, I mean, thankfully, we've been talking about this for a few years now, and there have been other ways to gain exposure to the asset class. So, hopefully, this is one of those things where at least, some of our clients have had a chance to kind of get exposure through those, other means. I think that being said, it is good to kind of maybe have that vehicle available going forward. But again, I think the tricky part is just, it's just so overdone right now that, people probably fall in one of two camps. Either they probably are kind of more on the savvier cutting edge and maybe have already figured out how to do it, or they probably don't fully understand what Bitcoin and crypto are, and they're probably going to be much more hesitant. So I get the sense that those who want to be in are probably in at this point.
Yeah, you make a really good point. Hey, I just want to get your take on, take a step back and just think about the global economy. We got inflation data that came in a little hotter than expected this morning. Surprising to me, Carol, that we didn't see more of a move when it came to yields, given that inflation data was a little hot. But as Mike McKee and Yelena Shalyetova
we did
out,
pop like on the news a little bit.
Did, but it didn't hold, right?
No, it did not hold.
Yeah,
we backed off.
And that was a little surprising to me. But like they said, things are moving in the right direction. Samir, I mean, does it make you think differently at all about asset allocations or your outlook for global fixed income, given that investors think, and they've priced in a series of rate cuts this year, and it seems like this last mile of inflation is going to be a bit tougher to get down?
Yeah, I mean, I think it'd be fair to say that at least the long end of the Treasury rates curve is probably priced for perfection. I mean, we literally just this week rolled out an alert, downgrading long-term fixed income from most favorable all the way back down to neutral. We've kind of gone, to that favorable positioning around 4.25 and kind of stuck with it throughout kind of that move up to 5% on the 10-year. And then this recent move lower just left us scratching our heads with respect to, again, to your point, that last mile inflation will be very difficult. Real rates as measured by current inflation relative to the 10-year is still pretty, net kind of low, right? You're not really getting compensated on that long end to take the risk if inflation is going to kind of get stuck in this 3 to 4% range, depending on which figure you're looking at. So from our standpoint, again, this is a great time to maybe park out in the short end, but we probably wouldn't be taking a lot of risk on the long-term end of the curve.
Yeah, it does make sense, right? We're getting much more clarity when it comes to expected monetary policy. We know it's tricky as we get near the end of this cycle for the Fed to get it exactly right and not overdo it. But it does feel like we have a lot more viewership, if you will, or view when it comes to the short term. Having said that, on the equity side of things, Samir, I'm looking at the 11 major industry groups in the S&P 500 this year, and energy is the second worst performing. It's down about 2.5%. We've seen a lot of consolidation, a lot of deals happening in this space. You guys are upgrading the energy sector from neutral to favorable. Let's start there. How come?
Yeah, so that same alert, we upgraded energy and we downgraded financials. Happy to speak to both. On the energy front, I mean, look, if the market's going to run on soft landing, right? If the Fed has somehow engineered this, which maybe we're a little skeptical, but let's say they actually have engineered this. Well, in that scenario, I can't imagine oil sticks in the low 70s, which is pretty much where it is right now. I can't imagine that you don't have at least some additional profitability on the energy equity side. And so this soft landing narrative is pretty much left energy kind of by the wayside. And honestly, if there is a little bit of an economic, stumble, we think that, energy prices and crude prices probably already reflect, what could be kind of a mild to moderate recession anyway. So, for all those different reasons, we saw probably as close to a free lunch based on valuations, based on this narrative that's kind of taken hold and just the relative performance.
Why are you skeptical that the Fed can pull off a soft landing?
Just because it takes, so much in terms of being able to judge the lags. I think there's a lot that, we're seeing right now with respect to the consumer hitting in their pocket. I just read a headline today on Bloomberg talking about how delinquencies are rising on credit cards. So, when you take all those different things into account, and the fact that, a lot of people, for whatever reason, either they're not selling their homes or they're not moving or they're not taking out new loans, have been able to avoid those higher interest rates. The problem is eventually you will have to buy a new car, buy a new home, move, all those different things. And when you do, there's a pretty good chance that you're going to be paying a rate that's maybe 2 to 3x what you last paid.
All right.